Okay. Did anybody see support.com? It got over $50 at one point. Unbelievable. I did a video yesterday, and I said it could hit 45, and I can't believe it actually hit 45. Unbelievable. It came right back down. So I hope if anybody did buy support.com, you put the stop loss in. I said you have to get out because it's going to crash. I don't know. It may come back up, but that would be really good if anybody got in and was able to get out around 40 or so. So last time I did the financial statements 101, I messed up the last year, 2023. So I'm gonna try to do it again. What's up, Lenworth? Thanks for joining. So this is just a company I put together. It's called Slippers Beyond Retail, and it's a manufacturer and wholesaler of slippers. So it's just a made-up company, just show you how the financial statements kind of connect with each other. And it gets a lot more complex than this, but I'm just trying to show you basically how they all work. And if you understand like what I'm doing here, it makes it a lot easier to read financials. So the first thing that pretty much any company does is they have to add cash. So we're going to add, the owner of the company adds $5 million of cash. So the cash on the balance sheet goes up $5 million, and assets equal liabilities plus equity. So it's not a liability, so we put it as equity. And it's a private company, so it says owner's equity. If it said shareholders' equity or stockholders' equity, that means it would be a public company. And it also goes in the cash flow from financing section under the statement of cash flows. Statement of cash flows is broken out into 3 sections: CFO, CFI, CFF. So the first thing is to add cash, and it really doesn't matter how the owner got the $5 million. He could have sold another business, or he could have saved the money, he could have robbed the bank. It really doesn't matter. Once the $5 million is on in this business on the balance sheet, now it's part of the company. So any way he got it in the past, he could have gotten it through debt or whatever. That's irrelevant. So now it's part of the company. So the first thing the company does is they buy inventory. The company they're buying the inventory from is called Slippy. They're just gonna, Slippy sells our company generic slippers. So we buy 1 million of inventory from Slippy. So that means our cash goes down $1 million. Because we send him a check or wire him the $1 million, and he mails us $1 million of slippers. That's our inventory. So that everything was contained within the asset section. Cash went down, inventory went up. So assets have to equal liabilities plus equity, and it does. Now, what we do as a company, we take the slippers, they're really generic, and we make them look really nice so that we're able to mark them up. So we sell them for $2 million to Walmart. So we sell our entire inventory of $2 million to Walmart. So they pay us $2 million for the $1 million of slippers we mail to them. So our revenue goes up $2 million. Our cost of revenue is $1 million because that's how much it cost us. And it gets a lot more complex than this. Like if it was a real company, we got to add $2 million to cash. If it's a real company, there will be more like supplies, and there'll be a lot of other things the company has to buy. I'm kind of making it real simple, just so the high level ideas gets across. So now we have to pay our employees. You see how the reconciliation is off $1 million? Assets does not equal liabilities plus equity. It's off $1 million. That's because at the end of each financial period, at the end of the 2020, we have to move net income to retained earnings to zero. So that $1 million will go to retained earnings. So it will balance. So we're going to pay 10 workers $50,000 each, which is $500,000. So we have to minus $500,000 from cash. And that goes in the cost of revenue because those are the workers who actually worked on making the slippers nicer. So that's part of our cost of revenue. Now we have to pay taxes. I'm just going to make it a simple 20% of what our profit is. So $100,000 of taxes. So we have to send a check to the IRS for $100,000. And let me know in the comments if you have any questions. So now we have $400,000 of net income. So to close out the year, because we're done with all our transactions for 2020. So when the year is over, we move net income over to retained earnings in order to zero out our income statement and start fresh in 2021. So you can see 2021, it's going to look exactly like the end of 2020, the balance sheet, because the balance sheet keeps rolling. It never gets zeroed out. So let's look at our financial statements and analyze them at the end of the year. We have to first put $400,000 on a statement of cash flows. So for the entire 2020, we had $500,000 of gross profit and $400,000 of net income for the year. So our profit is $400,000. And when we look at a statement of cash flows, our free cash flow is also $400,000. Free cash flow is cash flow from operations minus capital expenditures. We don't have any capex. So in the year, our net income equals our free cash flow, which is not always the case. Usually it doesn't equal. And you'll see that in later years. So it's pretty easy. It's a pretty simple first year to look at the financials and understand what's going on. The company had a $400,000 profit and they generated $400,000 of cash. And the change in cash is $5.4 million. So our cash went up 5.4 million for the year. That's just the sum of the three sections in the statement of cash flows. And to reconcile that, in 2019, we were in a business, so we had no cash. And at the end of 2020, you see that the cash on our balance sheet is 5.4 million. So our cash balance went up 5.4 million, which equals the change in cash in the statement of cash flows. So that's just a way to reconcile it. So now we're done with 2020. And then 2021, the balance sheet will look like this, and income statement and statement of cash flows will be zeroed out. They're zeroed out because no transactions have occurred so far in 2021. So it's all zero in those two, but the balance sheet continues on. So the first transaction for 2021 is we buy inventory from Slippy, our supplier. We're gonna buy 5 million of inventory, and we're gonna pay cash. So we have to send Slippy a check. We'll wire him $5 million, and our inventory goes up 5 million. Hope I don't mess up this time like last time. Last time, I know what I did last time. It was just a silly mistake. I'll show you when I get to it in 2023. So we're reconciled assets equal liabilities plus equity. You can see the zero there. Now the second transaction for 2021, and leave a comment. It makes me feel like I'm not by myself and talking to nobody. The second transaction is we sell all our inventory to Walmart, all 5 million. They're gonna buy everything again. So we have to wipe out our inventory, and that goes in the cost of revenue, because that's how much it cost us to generate the revenue. And this time they're not gonna pay us. Hey Ben, what's up? Your financial statement videos are golden. Thanks. Appreciate it. So so they're paying us half cash, half credit. So remember, the 5 million of inventory we sold them, we sell for 10 million. That's the whole point of a business. You have to mark up and make a profit. So we sold it for $10 million. So we have to book the revenue on the income statement. So we have to book the revenue even if we don't get any money, any cash. We have to book the revenue because that's when the transaction occurred. But in this case, we do receive some cash. We receive 5 million. And we have to book accounts receivable of 5 million. So we extended credit to Walmart, and we're pretty comfortable with that because we know they can afford to pay. They're not going to go out of business. That's a risk when you extend credit to companies. I know it helps you get sales as a business, but if you extend too much credit, then it ties up a lot of cash flow. And if companies go out of business, go bankrupt, you might lose a lot of money. So we're getting bigger as a company, and it's hard for us to keep making all the slippers. So we have to buy a machine to help us make the slippers faster. So the slipper making machine cost $1 million. So we're gonna wire $1 million to the manufacturer who makes the machine, and then we add that to PP&E, property, plant, and equipment, on the balance sheet, because now we have an asset, that machine, on our balance sheet, and we're gonna depreciate it. So the useful life of the machine, we'll put that also in CapEx. So the useful life of the machine is 5 years. So each year we're going to reduce $200,000 of the machine. So we put $200,000 on accumulated depreciation, and we put $200,000 onto the income statement under depreciation, which is a non-cash expense. So if you look at the income statement, you can see how much we paid for the machine initially. Say we bought it on January 1st of 2021. So by the end of, on December 31st, it would have been a full year. So the value of the machine, according to our balance sheet at the end of 2021, would be $800,000. Accumulated depreciation is a contra asset account. So you don't add it, you minus it. So to get the sum, to get our total assets, it's cash plus accounts receivables plus PP&E minus accumulated depreciation. Okay. 10 employees, $500,000 to $50,000 each, so $500,000. We're paying those employees, so that's $500,000 from cash, and that goes in the cost of revenue because those employees were right on the front lines making the product. So that goes in the cost of revenue. And now we have to pay taxes. So I'm just going to do a flat 20% just to make it simple. Sometimes I talk about taxes on the video. So the taxes on the income statement are not what a company pays to the IRS. It's just how much they calculate. What they pay to the IRS is usually different than what's on the income statement. It's a little confusing because GAAP has different, it calculates taxes differently than the IRS. It does equal out over time. If you look at it over a long time frame, it's the same, but in a given year, it's going to be different based on depreciation, because the IRS depreciates assets differently than GAAP. But you don't have to really understand that. It's interesting to know, but it's not going to make or break your decision on investing in a company, how much taxes they pay compared to what the IRS calculates. So $860,000 of taxes. So we have to send that to the IRS. I'm not going to make it too complicated. I'm going to just, whatever we put in the income statement is what we're going to pay the IRS. It would just be a nightmare for me to have to keep track of everything. And it probably wouldn't even make sense when I'm during the video. Okay. So let's double check. So we're off 3.4 million, and that's our net income. So we're reconciled. So the year is over. We have to move net income to retained earnings because we have to close out our income statement. And retained earnings is the sum of all your net incomes. So now we have 3.84 million of net income. So our income statement's complete for the year. If I was the accountant for the company, would be my job to do this. If after 5 years completely depreciated machine, are we still use it to 5 years? Then do we see that asset after that? There's still no. It's a good question. And we're going to write down the asset in the third year. In 2023, we're going to write it down to zero. But this is just what the value is according to the balance sheet. So an asset could be exactly after 5 years, the asset is worth nothing according to the balance sheet. So it's not on the balance sheet anymore. but we can use it for as long as we want. We could use it for 20, 30 years. It's like my car. It's worth nothing because it's so old. It's 20 years old, but I'm still using it. You can still use an asset even if it's depreciated down to nothing. But we'll get into that 2023. Okay, so let's do our statement of cash flows. So the CFO section is, let's calculate that. It starts with net income. And then, so annoying. Let me just change the order. Okay. I mean, not that it makes a difference with the numbers, but really, non-cash items should come before changes in working capital. So to calculate the CFO section, cash flow from operations, remember, CFO is net income converted to cash. That's pretty much what it is. And we pass through $200,000 depreciation expense. So we have to add that back to the CFO section. Because you see this $1 million, that's the machine. So we're passing through the entire $1 million in 2021. So we can't also have 200,000. We can't also record it in future years. It's a non-cash item because it's taken care of in the first year. I don't think I explained that well, but so depreciation is non-cash item, and then changes in working capital. So when accounts receivable goes up, does that improve our cash flow? Because obviously we had 0 accounts receivables last time. Now we have 5 million. So do I add 5 million in the CFO section or minus 5 million in the CFO section? Does anybody know? Because you have to adjust for changes in working capital. How do I do a poll? Who thinks I should increase right here, plus 5 million? Who thinks I should minus 5 million? So I got one minus. There must be a poll, way to do a poll. Yeah, because extend credit, it's not like we didn't have to pay $5 million to Walmart, but them not giving us 5 million is the same as us losing out of 5 million. So we have to, it has to be negative. When accounts receivables goes up, cash goes down. And then when they pay for the accounts receivables in the future, our cash goes up. And nothing from CFO section. Did I do this right? 440, 200,000 depreciation, 5 million. Did I mess up again? 10 million revenue. We had 5 million cost of revenue, 500,000 payroll. Does this look right? Did I miss anything? I feel like I'm missing something. Okay, 304.05 million, 1,200,000. It's hard to do this. 40. Okay, I think it's fine. So the end of 2021, we reported 3.4 million of profit. Okay, that's what I did. I knew I did something wrong. It's so confusing. And I know this stuff well. I built it, and I still like. That's what I did in 2023 in the last video. I'll show you what I did. But okay, so CapEx is minus because that's a cash outflow. We spent $1 million. I put a positive. That's why it was okay. So we reported 3.4 million of profit. So if an investor asked about the company, how do we do in 2021? We would say we generate $3.4 million. We have 3.4 million profit. So it looks great, but you should really look at a statement of cash flows in addition to the income statement. And most people don't look at a statement of cash flows. They don't really understand it. But so you can see in 2021, we actually lost 2.4 million of cash. So even though we reported 3.4 million profit, we were negative 2.4 million of cash. Because you see, in 2020, we ended the year at 5.4 million. In 2021, it was 2.4 million less, a little over 3 million. So we lost 2.4 million of cash. So as an investor, you would look at this and say, that doesn't look good. You know, they did report a big profit, but why did they lose so much money? And then you would see it's mainly because of this 5 million of accounts receivables. And then if you looked at it, if you knew it was from Walmart, you would say, okay, I'm not worried about that. Like, Walmart will pay. Like, they may take their time to pay, but they'll pay. So you would think it's fine as an investor. So the balance sheet will look identical at the end of 2021, and then it'll be zeroed out, the income statement and statement of cash flows. So now 2022 starts, and the first thing we do, the first transaction is, where do I see the initial cash? Is it retained earnings? What is that? What do you mean initial cash? I don't know what you mean by that. Well, meaning the cash balance at 2021? Yeah, just clarify. I'm not sure what you mean. So 2022, initial cash position for calculating change in cash. Oh, I see. So calculate the change in cash. You just look at what you ended 2020. You had 5.4 million at the end of 2020, and what you ended 2021, which was a little over 3 million. So that implies we had negative $2.4 million of cash flow in 2021 because our cash went from 5.4 million to 3 million. And that 2.36 million equals the CFO, CFI, and CFF sections, as you can see here. We lost 1.4 million from our operational business, and we lost $1 million from buying a machine. But as an investor, you would say, okay, that's good. They bought a machine. Hopefully, they'll grow from that. So you just have to look at it. I mean, all you can do is try to understand the numbers. There's really nothing you can do about the numbers. You can't make any changes to the company. Like if a company takes on a lot of debt, you just have to understand it. There's nothing you really can do about it. Okay, so we're starting 2022. The first transaction of the year is Walmart is going to pay us $5 million. Because they owe us $5 million. That's the first thing that happens. So that wipes out of our accounts receivables. Does anybody know what the company's name, Slippers Beyond Retail? Does anybody know what significance that has? Like, there's a reason I picked that name. Can anybody figure it out? Okay, so our cash went up. Accounts receivables goes down. Now we need more inventory, and we've been good customers with Slippy. We've been paying them, and we've been buying more each year. So he's willing to extend us credit. So he's going to send us $10 million of slippers, and we have to book accounts payable. So now we have debt. So we owe Slippy $10 million. Now, once again, Walmart takes our entire inventory off our hands. I always think of the balance sheet like a warehouse. It's just sitting there collecting dust. Visualize a warehouse. It's all dusty, and balance sheet is useless. It's just stuff sitting there waiting to get used as part of your business. Once it leaves the balance sheet and goes onto the income statement, then it's doing something. Then it's generating some type of either expense or income for your business. Okay, wait. Okay, so we're going to sell all 10 million to Walmart. So inventory, they wipe that off the balance sheet. You don't want to have stuff sitting on the balance sheet too long. Like some companies have inventory sitting there for decades. You don't want to have that. You want to have a clean balance sheet. So cost of revenue goes up 10 million. Once again, they're paying us half and half. So they're going to give us, they owe us $20 million, right? So let's book the revenue, right? Because it doesn't matter if they pay us anything, we have to book the revenue because that's the transaction occurred. That's accrual accounting. It's not cash accounting. It's whenever the transaction occurs. And they're going to pay us 10 in cash and 10 in receivables. So, and I'll do 2024, add some more stuff. I think we acquired a company in 2024, so I was going to do a goodwill impairment. Okay, so 10 million cash, 10 million receivables. So our balance sheet balances, it's off 10 million, but that's a net income, which will end up getting put into retained earnings. We have to depreciate the asset again because we're doing straight line depreciation. And with depreciation, you could choose sometimes your depreciation method. You could do a more accelerated depreciation. And the more you depreciate an asset in the early years, the lower, the less taxes you pay, because it brings down your netting, it brings down your profit. That means your cash flow goes up, and you pay less taxes. So if you're aggressive with your depreciation in the early years, you can save money, save cash. So accumulated depreciation is now 400,000, and depreciation is 200,000. So we still reconcile. Now we're going to IPO. We're going to go public. So we're going to IPO for $50 million. We're going to sell 10 million shares at $5 each. So we have to increase cash 50 million. So nobody knows the name of the company, why I chose Slippers Beyond Retail. There's a reason. Okay. 50 million in cash. So the way we have to book it in the equity section is it goes in the common stock and additional paid in capital. So 10 million shares of stock we sold. Is that like Bed Bath & Beyond? No, it has to do with me personally. Like there's some connection to me. So each share of stock has a par value assigned to it. It's usually a really low number. It has nothing to do with what the stock is worth in the market. It's just a way to kind of track the number of shares out there. Most companies use like a penny or a tenth of a penny or a hundredth of a penny. So the par value we're going to assign to each share is a penny. So 10 million times a penny is $100,000. So we put $100,000 in the common stock. Because if you ever look at the equity section, the common stock is really low. So it has nothing to do with the value of the stock. An additional paid in capital is usually a lot higher. That's a difference between what we received, the 50 million minus $100,000. So 49.9 million. So the sum of common stock and additional paid in capital is how much you received in your IPO. But most of it is put into additional paid in capital. I talk about that a lot in my videos, additional paid in capital. So we're still reconciled, okay? We have 15 employees. We have more employees, 50,000 each. So $750,000. We have to pay those employees in cash. And then that increases our cost of revenue because they actually made the slippers. And we hire an HR person as we're getting bigger. How many shares do the owners get who started the business? I mean, it's really up to the owners. They can get, it's different. I remember like Bill Gates owned half of Microsoft stock initially. I mean, it could be like 5%. It could be, it depends, kind of like a lot of different things. So if he didn't sell any of his stock, he would be the first trillionaire, because his stock will be worth about $1 trillion, his value. But he sold over the years. But you could break up shares however you want. You can do like a certain percentage for like the CFO, a certain percentage for different employees. And there's usually a lockout period. You can't sell until like 6 months after the IPO. Am I still doing it right? If you were to buy stock from your own company, would that come from your wallet? Yeah, that's separate from the company. Yeah, that would be from you personally. But the company could buy its own stock, which happens all the time, and that would remove it from the market, and they put into treasury stock in a balance on the equity section. Okay, so the payroll person is well, most companies have to stay private because they can't go public. They're just not big enough. Like probably 99.9% of companies wouldn't qualify to be public companies. You have to have a certain, I don't know all this things, but I know you have to have a certain amount. I think it's like 5 million of revenue, or you have to have a certain amount of capital. There's certain requirements. Plus, it's expensive to IPO. But it's a way to monetize your investment. If you own half a company, if you and your friends start a company, you're 50-50 partners, and then you IPO for like $100 million, you both get $50 million, right? If you're 50-50 partners. But like, remember somebody said, what percentage do they get? But you don't have to sell your shares. You can keep, say you and your friend who are 50-50 partners IPO'd for 100 million. If you kept half your stuff, if you kept only half your shares, so you both kept 25% of the company each. So instead of receiving $50 million each, you get 25 million, plus you keep 25% of the company. So you can do whatever you want. You could sell your entire, or keep it. Most people keep some. Some people just want to cash out. But it's the best way to monetize your investment is to IPO, and then you become an overnight millionaire, maybe even a billionaire. So HR 70 grand, so that comes out of cash, 70,000. And now their salary doesn't go into cost of revenue, because cost of revenue is only the revenue directly the expenses directly tied to generating the revenue. They go into SG&A, selling, general, and administrative expenses. Because even though they're part of the company, they're not actually making a product. There's a lot of people who work at a company, like a CEO, his salary doesn't go into cost of revenue. Only the people actually making a product. Like anybody in accounting, legal, it always goes into SG&A. It's all the same thing. It's just where you put it, what bucket you put it in. But it has the same end result. So we're still reconciled. Okay. Now we have to pay taxes. So 20%, 1.8 million. So we'll reduce our cash. So we have to send the IRS $1.796 million. And so now we're done with all our transactions for the year. So we move the net income over to retained earnings to close out the income statement. Let me just make sure yeah, okay. Just want to make sure I did everything right. So the income statement is done because all the transactions are complete. So we have to populate the statement of cash flows. Well, anytime you issue stock or take on debt, that goes into cash flow from financing. Anytime, so $50 million from IPOing, that's how much the company received. Anytime the company receives cash, it has to go into a statement of cash flows. And if they receive cash in that calendar year, it has to go in statement of cash flows. Now let's calculate the CFO section. We start with net income. Put 0 in CFI. Now we have to add back the non-cash items. So depreciation has to be added back. Because remember, in 2021, we reported negative $1 million. So we can't reduce another $200,000 every year because it'd be like double counting. So we have to always add that back because we already counted for the cash in 2021 when we actually bought the machine. Is that clear? I don't know if I'm doing a good job explaining that, but now we have to, accounts receivables increased. So it went from 5 million to 10 million. So that's negative 5 million for accounts receivables. Because when AR goes up, cash goes down. Accounts payables went up 10 million. So that's a cash inflow of $10 million. Because think of accounts payable as like a loan. Like if you go to the bank and get a cash loan of $10 million, obviously your cash went up $10 million. But if you bought $10 million of products from somebody and didn't pay them anything, it's still, even though your cash didn't go up, you got the product without paying for it. So it's, in a way, your cash went up. Do companies' accountants do these calculations on these statements daily? Yeah, I mean, everything goes into the computer. It's more automated. Every time there's a transaction that occurs, it's all linked up. And but the accountants need to keep everything reconciled and up to date. And it gets pretty confusing with all these, weird things that are going on. This is a really simplified way to do it. Okay, so it looks like I did everything right this time. So if we looked at the financials at the end of the year, like if I was an investor in a company, I'd have access to their financials. Or if I was a bank and I needed to look at their financials because maybe the company wanted a loan or something, I would look at the income statement and statement of cash flows. I would see they reported $7.2 million of profits in 2022. And then I would look at they actually generated 12.4 million of free cash flow. So I would look at it, I wonder, why did they generate so much more cash than they reported in their profit? And I would see it was mainly due to this accounts payable. They didn't pay this $10 million. Like they'll probably pay for it next year, but they didn't pay for it. So that's why their cash improved. And then the negative 5 million. So that's why it only went up 5 million instead of 10 million. So it would seems reasonable, makes sense. So now 2023 will look identical to this balance sheet. And this would be zeroed out. So 66. All right, and the cash. So if we reconcile cash, see 2021 cash was 3 million and it jumped way up to 65 million. So our cash balance went up $62 million. And we would look at the sum of the three sections, and that has to equal $62 million, and it does. I thought receivables was money that is owed to the company. Yeah, it is. And payables, exactly. receivables is what's owed to the company. Payables is what you owe. But depending on the movements, like if you sell something on credit, that's a cash negative for you when you sell it, because you're not getting any cash. You're sending out product that you had to pay for, right? And you're not getting anything for it. So that's a cash negative for you in that transaction. When they actually pay for what they owe you, it's a cash inflow. And that the outflow and inflow of cash may not happen the same reporting period. And that's how you track it on the statement of cash flows. Okay, so 2023, this is where I got stuck last time on the asset impairment. Because I just put 600,000. I'll show you when I get to it. So the first thing that occurs in 2023, because you see it's all zero, these two statements. Slippage beyond retail has no debt, right? Well, we have $10 million of debt of accounts payable, but yeah, we don't have any like long-term debt or any I guess, right, we would have no debt. That's a good idea. I'll take a bank loan or maybe sell some debt to the public maybe in 2024. So I could book the debt and the interest expense. That's a good idea. No loans. Yeah, no, that's true. No debt. But that doesn't mean your company's good if it's no debt or it's bad. People get hung up on like, you need to find a company that has low debt. You need to find a company that has a lot of assets, that has, and that might be good, but you have to look at a lot of other things because you may be missing the whole story. Did anybody buy support.com? It went up over to $50. And I made a video saying that. I said, it's probably going to hit 45, but you have to get out if it does hit that. I mean, I just got lucky by saying that. Okay, so the first transaction is Walmart's paying us $10 million. So we could zero out accounts receivable and increase cash. Yeah. So increase cash $10 million. And now we're going to pay. I saw the video too late. We're going to pay our supplier Slippy $10 million. The accounts payable, because he extended us credit last year, we are going to pay him this year. So now we're going to minus $10 million. Yeah. Okay, just confirming it. Everything. Yeah, you post Canadian stocks video. I do post it less now. It's really what people ask for. I'm doing one tomorrow, KITS, KITS on the TSX. Yeah, so we're still reconciled. Buy inventory. So now we're going to buy 30 million of inventory all on credit from our supplier. That's what you want when you invest in a company that has little accounts receivables and lots of accounts payable, because that gives them lots of cash to work with. They don't have any cash tied up. Our inventory goes up 30 million. Yeah, alimentation Couche-Tard. Yeah, that's a good one. ASTS. What company is that? ASTS? Because I know there's a few companies that people ask me to do that I can't do it. Like certain finance companies, most finance companies I can't really do, or insurance companies. It's too difficult. I don't know if that's one of them. Okay, so now we're going to sell 20 million of inventory to Walmart. They're not taking all our inventory. They're just taking 20 or 30 million. So we got to reduce inventory 20 million. And that goes in the cost of revenue. You quit your job? That's awesome. And you're just going to live off your investments? So cost of revenue goes up 20 million. And once again, they're paying us half in credit, half in cash. So they owe us 40 million. So we're going to put revenue 40 million and book 20 million to accounts receivable. And cash goes up 20 million. Am I still balanced? Yeah, everything I think looks good. We got to pay our 15 employees. $50,000 each, so $750,000 minus 750. Cost of revenue goes up 750. HR, we're paying them $80,000 this time. The salary went up, so minus 80,000. And that goes into SG&A, selling, general, and administrative expenses. This is where, I don't know why I have pay taxes before accumulated depreciation. Okay, so this is what happened last time. Have you checked any worse stocks? No. Okay. I appreciate the donation. That means a lot. Thank you. So the machine, according to our balance sheet, the slip making machine is valued at $600,000 because we bought it for a million. We depreciated 400,000. So our book value is $600,000. But a new machine. Close the door. Concentrate. So the company came out with a new machine. It's actually cheaper. It's like $800,000 to buy the new machine, where we paid $1 million, and it's much better. Technology just got a lot better. So the machine we have is worth nothing. Like, we couldn't sell it for anything in the open market. Nobody would buy it because they'd rather pay less for a much better machine. Yeah, I did alkaline water. So we have to report our assets accurately. And since this machine has zero market value, we're going to pass through an asset impairment of $600,000. This is where I messed up. I put $600,000 last time. Negative $600,000. And now we wipe it off our balance sheet. But that doesn't mean we have to throw away the machine. That's just what the machine is worth in open market. Like my car, I don't have to throw my car away just because it has zero value. It's zero Kelly book value. It still runs fine. I can use it. We can use this machine for 20 more years if we want to. Even if it has, nobody would buy it from us. It works for us. So, but we have to report the asset accurately. So because somebody asked that question earlier, I don't know if that clarifies it. So we're writing down the entire asset because that $1 million machine has to go onto our income statement, all million. And whether we depreciate it or we pass through an impairment, at some point, if you add up all our income statements, that $1 million will be spread out onto our income statements. Okay, I gotta get better at explaining this. I'm not sure if I explained it clearly, but so now we have to pay taxes. Okay, so everything looks good. So I'm just going to do 20%, like I've always done. So 20% of our pre-tax income is 3.714. So I'm going to minus that. That's how much we're going to send to the IRS. 3.7 million. Okay. So everything looks good. Our reconciliation looks good. So when I initially set up these spreadsheets, I had everything linked, so I couldn't make any mistakes. But as I'm doing it manually, it's just like, it's easy to make a mistake. And now we have to close out the year. We move our net income over retained earnings. Even if net income was negative, it goes to retained earnings. Retained earnings can be negative, and it is negative for a lot of companies. Plus 14, 8, 5, 6, 3. Do statement of cash flows. Okay. Is everybody following? Okay. So now our income statement is done. Let's do statement of cash flows. We start with net income. And now the asset impairment, that's a non-cash item, remember? Because that $1 million was passed through in 2021 when we bought the machine. So we have to adjust every time we pass through an expense, so we're not double counting. So we have to add back $600,000. It's kind of like the opposite of the income statement. So we minus it on the income statement, so we have to add it back. If it was the opposite, if we added it on the income statement, you could have it. If we say we sold a machine, right, for $700,000, we would have a gain. We would make $100,000. Anyways, okay, we'll just move on. Maybe I'll put that together maybe the next year so I can explain it maybe better. Now our accounts receivables went up, right? What was it last time? 10 million. Now it's 20 million. So when accounts receivables goes up, cash goes down. And our inventory went from it was nothing, our inventory at the end of 2022. Now it's 10 million. So when inventory goes up, cash goes down. I mean, I understand this, but it's still kind of like seems convoluted to try to explain it. Because when you buy lots and lots of inventory, thank you, Dave. Really appreciate it. It's really nice. So if you buy a ton of inventory, right, which happens a lot right before the holidays, certain companies really load up on inventory, like retail stores, because they're going to have a ton of shoppers coming in buying stuff. So they load up on inventory. But that really wipes out a lot of cash, right, for the company. Because say they buy tons of inventory in September, October, November in preparation for the big month in December. They're probably selling some before December as well, but that's the real big month. So they're really draining the cash flow. So that's killed a lot of companies. I knew this guy who I don't want to talk about it, but yeah, if you overbuy on inventory, that could wipe you out, because if you can't sell all the inventory and then you have to pay your bills and you have to pay the interest on your debt, it could wipe out a company. And then our accounts payables went up. It went from 10 million to 30 million, right? So when accounts payable goes up, cash goes up, because it's like a loan, right? It's the same. Accounts payable is the same as taking a loan from the bank, except you're not receiving cash, you're receiving a product. Do statement of cash flow before. Okay. So everything ties so far. We reported 14.9 million of profit, but we actually generated 15.5 million of cash. So our cash went up more than our net income. And the way you reconcile at 2021, we had 65.4 million of cash on our balance sheet at the end of 2022. Now we have 81 million about. So our cash went up $15.5 million. And we could look at a statement of cash flows and to verify what that $15.5 million was made up of. And it's pretty much just everything from CFO, the CFO section. But at the end of the year, the board gets together and we're like, we're doing really well as a company, so let's expand. So there's different ways to expand, right? You could do it organically by having your sales team go out there, try to get new retail stores to buy from you, like Target. Right now, we just have Walmart. We want other stores buying from us. Or you could just acquire another company, which is another way to expand, right? You can double your revenue overnight, just buy another company. And that's what we do. We wear slippers beyond retail, and there's another company called Sandals Beyond Retail. So they do the same thing we do, except it's sandals. So pretty much the way it works is you would look at their balance sheet to see what they're worth. And according to their balance sheet, does anybody know what they're worth? There's only two things on their balance sheet. It's they have 4 million of inventory and 1 million of accounts payable. So what is their book value? Like, what's the company worth according to its balance sheet? Forget about this 2 million goodwill. That's not on their balance sheet. This is their balance sheet. They only have two things. I made it real simple. They have inventory and accounts payable. So what's the company worth according to the balance sheet. Obviously, it's your balance sheet isn't what you're worth, because you might have other, right, 3 million. So they want to sell for 5 million, and then we agree. Why would we pay more than it's worth? Well, just because according to your balance sheet you're worth 3 million doesn't really mean you're worth 3 million. Maybe they have a relationship with Target, and that's what we want. And one way to get a relationship with Target is just to acquire this company, because Target's going to probably still buy from them, even if we own them, and then we can introduce our slippers to them. So there's a lot of value beyond what they're worth according to the balance sheet. They may have a good brand name. Maybe they're more well known in certain communities. Maybe there's just an employee at the company. We could. I mean, I didn't, because we have a lot of cash on our balance sheet. So I'm just going to use cash to acquire the company. And I'll show you that in a little bit. And we could. A lot of companies issue debt to acquire a company. There's a lot of ways to do it. Or you can issue stock. I'm just going to use cash, because it's not, if the company was like $100 million to acquire them, we couldn't use cash because we don't have that much cash. So we'd either have to raise more capital, either stock or debt. It's really the two ways to raise capital. You dilute your shareholders, or you issue debt. Are those connections an extra? Are those that means are those connections an extra value considered goodwill? So I was just going like, why we paid more than it's worth, and that pretty much happens almost every time. A company pays more than it's worth, but sometimes you pay less than it's worth. Like it's worth 3 million according to the balance sheet. Sometimes companies pay less than it's worth, maybe 2.5 million to 2 million. That's called a distressed sale. That's not too common, because usually if the company is you're paying less to buy the company, most of the time you wouldn't even buy the company. It's probably not that good of a company. But we're willing to pay an extra $2 million because there could be tons of things. There could be like there could be an employee at the company that's really, really good at designing sandals, and he's just really well known for that. And he has like this, and we can't find anybody who has these similar skills. So by acquiring a company, now we get him, and he can help us design our slippers. Or they may have a special process, like their warehouse may be really streamlined, and they could get things done so much faster than us. So instead of us trying to build out the infrastructure of a new factory, just acquire them, and then we can use their factory, and it would save us a lot of money because we're overspending. I know there's millions of reasons why you would pay more. So to acquire them, we have to take 5 million of cash, and we give it to. We're going to pretend it's one guy that owns a company. He has a bunch of employees too, but he owns a company. So we give him $5 million. If they also had 2 million debt, if they had 2 million, well, they have 1 million of payables. If they had 2 million of debt, then they're worth $1 million, because 4 million minus 1 million minus 2 million is they'd be worth $1 million. Their book value. So Bob owns Sandals Beyond Retail. He started the company, he grew it, and we cut him a check for $5 million. He owns it by himself. So Bob can be like, I'm out of here. He goes to he retires. He brings his family to a tropical island, and he wants to he can do whatever he wants, really. Or Bob may stay. We're gonna go, Bob, we'll give you $200,000, and that's for 2 years, and just stay with us for 2 years with $200,000 up front. Just stay with us because we want to make sure the transition is smooth. So it could be a lot of things you can do with Bob. It's really up to Bob. We obviously have a contract in place. If we said we'll acquire you, we'll give you $5 million, but you have to stay on for 6 months to help us with the transition. Whatever it is, it doesn't really matter. So we write a check to Bob, $5 million. He puts it in his bank. But we have to book. So we're going to just move their balance sheet onto ours. So they have $4 million of inventory in their warehouse. So we're just going to take that inventory because we bought the company. It's ours. So now we have to increase inventory $4 million. And they have $1 million of payables. They owe one of their suppliers $1 million. So we have to assume everything. We can't just assume the good stuff. We have to assume the bad stuff also. A company can have toxic debt. If we acquire them, we have to build that into our acquisition costs. So, which we did. We knew what we're taking on. So we have to add that $1 million of debt onto it. So now we have 110 million of assets, 31 million of liabilities, 81 million of equity. So we're off $2 million. Everybody knows what we're going to do with $2 million because we gave Bob $5 million. So our assets went down $5 million, and then we added $4 million of inventory. So our assets went up $4 million. And then we added $1 million of payables. So we're off $2 million. That's where goodwill comes in. It's just a plug. Goodwill is kind of a meaningless asset. So when you acquire a company for more than its net assets, that goes into goodwill. It's pretty simple, right? This is the most simple way I could have crafted this. If I wanted to be super technical, it would be so confusing. And even I don't understand it that thoroughly, but you'd have to, they don't have assets, but you have to revalue the assets because sometimes the balance sheet is not accurate, right? Like if we had a machine on our balance sheet like that machine we had, if we didn't impair it, we still had that on our balance sheet, we'd have to revalue everything in property, plant, and equipment to make sure it's valued accurately. So we might have to actually write down some assets to get the true book value, or maybe even increase assets. Is goodwill also depreciate? No. Goodwill used to, I forgot what year, maybe 2007. It used to be amortized. Goodwill used to be amortized because goodwill is intangible, right? Like a patent or trademark. It's an intangible asset. You can't depreciate an intangible asset. You amortize it. You can depreciate a tangible asset like a machine or a vehicle. So you can only depreciate tangible, amortize intangibles. although the only intangible asset you don't amortize is goodwill. A trademark you would amortize each year, but a goodwill every year, which we'll probably do maybe next video, because in 2024 we would have to look at our acquisition of Sandals Beyond Retail, and say at the end of 2024, right? If we got hardly any sales from slippers from Sandals Beyond Retail, like we acquired them thinking now we're going to sell sandals to Target, and Target's like, you know, I like Bob, working with Bob. This happened with Microsoft when they acquired that phone company. But anyways, so we acquired Sandals Beyond Retail, and then the idea was to get that relationship with Target, and then in 2024 when we start trying to build a relationship with Target, so how do you claim tax deductions for entire acquisition? You don't claim tax deductions for an acquisition. So I'm just giving you a scenario. So say we got hardly any sales from Sandals Beyond Retail because they like to work with Bob. They like that relationship. Maybe Bob's best friend worked at Target, whatever it is. So we didn't get really much sales from Sandals Beyond Retail. Say they got $1 million in sales in 2023, and we got like 100,000. So at the end of 2024, because Sandals Beyond Retail did so poorly as a business, we would look at it, we would say, you know, we pay $5 million, and it's probably worth, we probably should have paid $4 million because it's really not as good as we thought. So we have to pass through a goodwill impairment. So we have to reduce goodwill $1 million. If we deduced it should have been $4 million. It's worth $4 million today, not the $5 million we paid. We'd have to reduce goodwill by $1 million, and then pass through a goodwill impairment onto the income statement, right? So that would be negative. So we would reduce our asset $1 million of goodwill. We would also reduce retained earnings $1 million, because remember, anything that goes on the income statement drops down to the bottom, gets passed on to retained earnings. But goodwill impairment, I don't think many people know this, but goodwill impairment doesn't benefit you tax-wise. So, like for instance, if we impaired, let's just give an extreme example. Say we had like $100 million of goodwill on our balance sheet, and we did a goodwill impairment of like $50 million. That doesn't mean, it would seem like we would report negative net income that year, but we don't save anything on taxes. You have to strip out goodwill impairment when calculating your taxes. But let me bring it back to but an asset impairment, like on a fixed asset or tangible asset, we could reduce that from our tax bill and save money on taxes. But a goodwill impairment doesn't help our taxes out. We can't. We would report it on the income statement, but we might have like I said, let's just do 20 million. So we might have like negative $800,000 of income, but we would pay like whatever, let's say 20% of 19 million. We would pay $3 million in taxes because goodwill wouldn't help our taxes out. Like a goodwill impairment So we'd still have to pay taxes on our profit, even though we reported negative net income. And that would obviously bring it down our net income even more, because in this case we have negative $800,000 of pre-tax income. We pay $3.8 million taxes, and we have negative $4.7 million of net income. It looks weird, but does that make sense? Like, why don't you pay tax? Why doesn't it help you with taxes? Goodwill impairments. Like, you can impair a vehicle or you can impair anything else, and it will reduce your tax bill. But goodwill, it doesn't help you with your taxes. You have to exclude that. I think I understand why. I was trying to think of, I don't know if I could verbalize it. Because when you buy a machine, of course it's not intangible, because it's intangible. But I gotta, I'm pretty sure when you impair like trademarks, that gets a tax deduction. Only goodwill. I gotta double check that. I know goodwill, you don't get a tax savings, but I was just under the impression that we can claim for taxes all investment activities, but now you've explained it. Now, I'm not sure. I think only for goodwill, you don't get that tax benefit, but I think other intangibles, you get the tax benefit when you impair it. I was trying to think, like, if you acquire a company, I think because when you acquire a company, I got to think about this more. I think in my head I kind of get it, but it's a little confusing. But yeah, but it's, most people don't know that. They think, oh, these huge goodwill impairments will help you tax-wise, but it doesn't. Can anybody Google, do you get a tax break from like impairing a trademark or impairing I'm gonna double check that. But yeah, so too much goodwill in balance sheet could be. No, I wouldn't say that. Too much goodwill in balance sheet is a red flag. There's no such thing as a red flag on its own. You know, any single thing. You know, I gave plenty of people examples. Like, oh, negative equity, that's bad. That means your liabilities are greater than your assets. So that's bad. That's a terrible company. But I could think you can have a really profitable company that's bringing tons of cash that has negative equity. Boeing has negative equity. A lot of goodwill just means you acquire a lot of companies. And I'm not saying it's a bad thing. I think acquiring a company is a neutral thing. I don't think it's good or bad. I don't see it positive or negative. Because you're just using cash and you're receiving an asset. It's like if you buy a machine or equipment or a vehicle, you're paying for something and you're getting an asset. And yeah, the idea is you would grow your business and make it bigger with that asset, but there's no guarantee. Like, if you buy a car for your business, I don't know if that's going to help you generate more sales because you're able to get places quicker. It could. That's the idea when you buy any asset. But until you actually prove that, I don't see it as a positive or negative. So Apple doesn't have any goodwill. on its balance sheet. Like it's just like it's all organic. I mean, they acquire companies, but don't some companies' stock goes down if growth is by acquisitions all the time? I mean, it could if a company's acquiring a lot of companies, but they're able to acquire them, and it helps their company grow even more. Like you can acquire companies. You obviously have to acquire companies that have similarities that kind of benefit each other. And if that's the case, then then it's good you acquired all these companies. If it made your company grow even more. Like if your company has $1 million in sales and a company you're acquiring has $1 million in sales, and together you have $3 million in sales, that was a good acquisition, right? Because instead of 1 and 1, you have 3. If you have $1 million and this company has $1 million, together you have $2 million, it's neither positive or negative. It's just even. There's no benefit if you did the acquisition or not. But if you both have $1 million and together it's 1.5 million of sales, which is possible, that's a negative. That's a bad acquisition. So anything could be good or bad. If you invest in a factory to start making cars, right? But the factory turns out to be nobody wants to work, or the taxes are too high, or there's just so many problems, and you shut down a factory, then it was bad, right? To buy that factory. So there's no positive or negative. It depends what they do with it. Just like hiring an employee, if that employee steals from you and you fire them, it was a bad decision to hire them. But if that employee invents something and makes your company great, it's not as clear cut. But yeah, I think this was helpful because it helps me talk about these things more, and it ingrains them in my head more. Okay, I'm gonna get off. Thanks for sticking around, and I'll try to come up with something else. Maybe I'll do 2024 on the next call. Okay, good night, everybody.